This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Jonathan Farrow and Lisa Abramowitz. Join us each day for insight from the best in economics, geopolitics, finance, and investment. Subscribe to Bloomberg Surveillance on Demand on Apple, Spotify, and anywhere you get your podcasts. And always on Bloomberg.com, the Bloomberg Terminal, and the Bloomberg Business app.
We begin the program with Laurie Cavacina, head of US equity strategy at RBC Capital Markets. Laurie, good morning. We hope you all had a wonderful Thanksgiving. I want to kick off with your call. 5,000 rather, year end on the S&P 500 for next year. Deutsche Bank going one further at 5,100. Laurie, talk to us about the path to 5K.
Well, thanks for having me as always. And look, we purposefully did not put out, we see a near-term pullback, then a resurgence. I think a lot of people got caught in that trap in 2023, calling for a near-term pullback in the first quarter that didn't end up happening. I do think we'll be watching our sentiment indicator very closely. It's been the best star in the sky to navigate the equity market this year, but it's also round-tripped a couple times. It started out giving you a screaming buy signal because of deep pessimism, returned to that post-SVB, gave a sell signal in August, and then gave a buy signal again in November. So I think we're going to have to just be very tactical in that. I have been telling people November is very consistently a strong month, but December is a little bit more hit or miss. So we'll see if we end up getting the Santa or Grinch in December. But I do think the path for equities is higher next year. And if we do have a bit of a short-term pullback either in December or to start the year, I expect it to be temporary.
Laurie, Goldman Sachs had a note, thanks Zero Hedge for this, on sales growth looking out 2 years, 23, 24, 25. And the difference between the Magnificent Seven with 11% sales growth versus the SPX 493 of 3% sales growth. Why would anybody sell the Magnificent Seven right now?
I think it's a great question, Tom. When we look at our indicators and we look at the mega cap growth trade broadly, it looks crowded. If you look at the weekly CFTC data on NASDAQ 100 futures positioning, we're basically close to peak valuation and growth relative to value if you look at the Russell 1000 on a weighted PE multiple, which is going to be very heavily influenced by that Magnificent Seven. And if you look at earnings momentum, we're still seeing better earnings revision trends in growth and value, but value is starting to catch up a little bit. So we are seeing that leadership on the earnings side fade a little bit. All of that tells me that there should be a pause in growth leadership at some point. But I think one of the reasons people can't really permanently quit these growth stocks is, kind of hitting on exactly what you said, the idea that there will be superior growth there over the intermediate term. And if you look at GDP forecasts for next year, 1% in real terms anticipated by the street, 1.8% in 2025. When we're in a sub 2% GDP environment, growth stocks usually do outperform because economic growth is perceived to be scarce. So I do think there is a real tension. We still like the tech sector, even though we have these shorter term tactical concerns on growth. Had those tactical concerns on growth, frankly, for a while, and they've yet to really materialize in a big way. And I do feel like you may need to see a real ratcheting up of GDP expectations before you can really see growth lose some of that leadership dominance.
When you talk about sentiment and how really that's been the lodestone for you, it's figuring out where is investor sentiment and betting against it. Am I correct?
Basically, one of the things I've learned over my career, Lisa, is that when everybody is really, really pessimistic, that's usually a fantastic time to buy. If you look at when the AAII net bullishness indicator is, sort of one standard deviation or two standard deviations below the long-term average, I forget the exact stat, but it's in the 80s in terms of the percent of time that you're up 12 months later. And you see similar stats if you look on the flip side when people are overly enthusiastic. Now, if you're above one standard deviation on extreme optimism, you still tend to see like a 5% gain over the next 12 months. So it's not necessarily a washout, but it does tell you that you tend to see consolidation. You do tend to see some choppier markets. And I think that's why it's so important, Lisa, to really prioritize data over narratives. I know a lot of strategists like to tell a great story and then they go out and put together their charts to try to fit whatever narrative they're pushing out there. But I really think that you have to stick to the data, and things like that sentiment indicator will keep you into falling into consensus traps. Again, when everybody just sort of gloms onto the same narrative and things get too extreme.
Well, the narrative that we've been hearing again and again is 5,000 on the S&P going into next year, at least if not more. And there has been a sort of boom in optimism that we've seen. Does that mean it's time to start taking some chips off the table and to be a little bit less optimistic? Or does this mean that finally you might see some of that cash at record levels going into the equity market?
Well, it's interesting, Lisa. Everybody wants to sort of talk about this idea, and this is maybe on the more bearish side of the table, that bonds look more attractive than stocks and the earnings yield has collapsed relative to the bond yield. And all that is true. But if you actually go back, there have been periods in history when equity investors or investors in general have taken up both their equity allocations and their bond allocations at the same time. So I don't think it's unheard of for both to do well. 5,000 is starting to be a number we're hearing a lot. I think we were maybe the second person on the sell side that had it when we put ours out, but you are starting to hear about it. And I think 10% is usually a reasonable place that a lot of strategists start. We do have one model that can take us up to 5,300, and that's looking at our valuation work and earnings work. And I will tell you, Lisa, as I was putting the report together, you always think about kind of where did you go wrong in the past year. I was more optimistic than most, but not optimistic in the end. And that valuation model was the one thing that was telling me all year to look for 4,700, 4,800 on the S&P. It's pointing to 4,700 on the end of the year now for 2023. One point it was saying 48, 49. So I do think you have to have a little bit of humility when you look at these forecasts. We look at a bunch of different models. We take the median. Some are more constructive, some are less. But I do think we do have to pay attention to that bull case heading into next year, because that's really what worked this year.
Does that mean a banner Calvacina says 5,300?
Not
I
quite,
think we can go there.
Not quite. I think we're sticking with 5K. Laurie, I just wanted to jump in. When you were putting this together, surely 5K was something like 20% upside at the time.
So, John, I started back in October pricing the models, and we actually published a report in October where we said we're not going to do our target yet, but here's what all the models are showing. And back then we were getting, a little bit of a more subdued number because we had a lower starting point. So we did price everything as of mid-November. I think a lot of our models we froze as November 15th, November 16th. So we really are kind of getting sort of a true 10% from current conditions as of mid-November. Basically, when I do this, John, I go into a black hole for a few days, don't answer my phone, don't answer email, and don't talk to anybody, and update all at once. So
well, welcome back out of the black hole, Laurie. We're happy to see you. Laurie Cavacina, RBC Capital Markets.
There's no one better to speak to on this as if you stand at the four corners of 57th Street and Fifth Avenue. The Dana Telsey is a child gazing upon Bergdorf Goodman and across the street to Tiffany's and where Louis Vuitton is now, and there's some other unpronounceable I can't afford store on the other corner. Telsey joins us now, CEO, Chief Research Officer of her Telsey Advisory Group. You got this right. A lot of people got this wrong. How did you expect this optimism that we come out of the season?
Well, thank you very much for having me, and hope you guys had a great holiday.
It was okay.
I think overall, keep in mind, we did have a barrage of earnings reports all talking about the cautious consumer. Inventory levels are lean. Promotions were in place, 30 to 40%. That isn't outstanding. That isn't going off the rails in terms of level of promotions. They were definitely clean. What you saw in terms of traffic, look at the Lululemons, the Bath & Body Works. Macy's had more traffic than what you had at Nordstrom. And off-pricers like TJX had a ton of traffic. And the teen retailers picked up. The reason why? Value and innovation. If you had value and you had innovation, the consumer was coming. So look at Uggs and Hoka where there was innovation. You look at the value on the pricing, it meant something. But we have a long season coming up now. Christmas is on a Monday. Watch that weekend before Christmas, because procrastinators, it's their choice of when they want to spend.
Just let's build on that, this idea of watch what happens later in the season. Are you saying that you suspect people brought forward their shopping much more than they had in the past because they are being cautious? So the numbers are inflated to represent that more than just excessive spending altogether.
Yes, I think you look at the savings rate, which has come down, you take a look at delinquencies, which have gone up, and you look at what's happened with the pattern of promotions. It began in October. So with Amazon Prime Day in October, their second Prime Day, you had a pull forward of what the promos were, and of course online is going to be strong. Stores are no longer open on Thanksgiving Day. So what did people do? They shop with their phone. Mobile mattered.
Well, this really raises this question. Is it the modality of shopping that matters right now, or is it the type of product mix that matters right now? And I'm curious, can you parse that up? Is it just online shopping, or is it the products that people are getting online?
It's the products that people are getting. And don't throw out the stores. The stores matter. The engagement that people have, the social interaction. So many companies in 2023 came out with new store formats. You look at on-mall and off-mall, they both won. And even outlets are strong in that measure for value.
Where's the best total return out 12 months? You and Joe Feldman are not on speaking terms on this, but the basic idea of which kind of retail and which individual stock is the best possibility.
Off-price, I think, is going to win over the next 12 months. TJ Maxx with
so
their...
that's Hermes, Louis Vuitton,
off-price.
LVMH, off-price.
Not luxury.
Okay, so continue.
Different world. It's off-price. It's the TJ Maxxes of the world, the Burlingtons and the Ross stores. Why? They're getting the benefit of a trade down. Look at what you just saw in their results last week when they each delivered same-store sales of at least 5%. Typically, these are 3% same-store sales increases. They're getting the benefit of the trade down.
There's been a heritage of TJ Maxx executing. What's the secret sauce that makes them do that?
The experience of their buyers. They know how to buy. They have the relationships with brands. Brands like being in their stores, and they sell through. And don't forget their locations.
The description that you're painting of the American consumer is not that positive. It's one that is trading down, as you said. It's one that has caution, that might not show up in force before that Monday Christmas. So where are we in this cycle, right? I mean, is this a matter of people running out of money, or is it just them saying, well, we've been spending a lot recently, we probably should be a little more prudent?
They had more money 2 years ago with the stimulus package during the pandemic. The low to middle income consumer is battered right now by higher interest rates. Even though inflation's moderating, it's still a higher price than it was in the past. And even you take a look at the luxury consumer, you need the feel-good factor. With the geopolitical issues going on, the macro headwinds out there, and the volatility of the stock market, it makes it more challenging. So that's why experience, look at the Taylor Swift concerts over the summer, what people are willing to spend on, give them something innovative, they'll be there.
So what does this say about the trajectory of the consumer and how people are going to be spending? Is this the beginning of more pain, or is this basically the bulk of it?
I think this is in the middle of the pain that we're seeing. I think the focus on essentials is right there. I think you need newness in order to drive demand. And even though the labor market continues to remain very good, the watchwords are out there and saying, what's it going to look like? And inventory is cleaner, so you don't need to promote as deeply as you had in the past. Look at what's happening with the department stores. They're ordering more cautiously. And why are they ordering cautiously? If they don't feel the demand is going to be there, they'd rather sell at full price than markdowns, and your most profitable markdown is your lowest markdown, not your greatest markdown.
Toughest job in retail this year is a guy named Sabata DeSarno at Gucci. Absolute toughest job. Dana Telsey on what Gucci's going to do right off that corner of 5th Avenue and 57th.
I think they're going more basic than they've ever been before.
Absolutely. They're going away from what the idiocy was for 3 years.
Yeah, the mismatching of the 3 years is all about matching now, and it's about safe. They're going back to their archives and seeing what can they reinvent and update for today.
Is there proof that we want that? Is there proof that will sell to the Chinese?
I think there's some proof it'll sell to the Chinese, but we're not seeing the Chinese travel yet. We need them traveling to really drive demand. And don't forget, you're seeing the local Europeans slow down also.
What do you make of the buy now, pay later? And we were hearing that it's actually picking up. Do you think that this is a positive sign for the retail world, or is it a negative sign that people are just basically turning to leverage?
People are turning towards leverage. When buy now, pay later first came out, it was a huge event, a huge development, because it got younger people and, frankly, the millennials to spend. I think now that it's been around for a few years, if they can't pay on time, they're willing to delay and, frankly, be able to extend what their payment terms are.
Is it changing charge cards? I mean, is buy now, pay later changing the charge card business?
Not what we've seen. It didn't take off tremendously. It took off with a certain demographic, and those were the millennials.
Single best buy, go.
I think that it's going to be TJX. I think TJX is going to be the winner for holiday in 2024.
Dana, thank you for the brief. Dana Telsey with us,
Thank you.
Telsey Advisory Group here. We have seen far too much of him. He is an expert on turmoil, war, and terrorism. Aaron David Miller with a continued brief, senior fellow, Carnegie Endowment for International Peace. Aaron, let me cut to the chase. If we get out to a point of negotiation, from where you sit, is there a Hamas to negotiate with now?
There is, and the Qataris and the Americans are validating Hamas's effectiveness. The three of you are better analysts than I am because you've, I think, identified the core questions. There's growing daylight. The world is mad at Joe Biden, even though I think, Frank, his own party's mad at him. There's a degree, 25 years at Department of State, I've never seen, the degree of dissension and vocal opposition to an administration's policy from inside the foreign policy and national security space. One resignation, but an extraordinary amount of noise. I think the president, frankly, handled this pretty effectively. The Israeli-Lebanese border is relatively quiet. The fears of escalation into a regional war, which could produce plunging financial markets and rising oil prices. So far, that's been avoided. And you're right to focus on hostages. But I think the deal is very clear. I'd be stunned, frankly, if this humanitarian pause collapsed. Hamas is trading hostages for time. They're hoping that the hostage families inside of Israel will continue to pressure the government in order to redeem all of the hostages that have not been returned. The Arabs are angry, and the Israelis are going to face probably in the next week, if the 10 hostages for a day of quiet, which is the offer on the table, if Hamas accepts that, doesn't add requests for more Palestinian prisoners, you could get another week out of this. But at some point, the Israelis are going to want to resume their ground campaign. And at that point, I think you're going to see growing awkwardness and uncomfortableness, maybe even tension, in the U.S.-Israeli relationship.
There's daylight between President Biden and some of his own members within his party, within his team that he has surrounding him. But he also reportedly has expressed concern about the collateral damage, about the civilians who have gotten killed, the incredible number, more than people had originally expected. How much is that going to lead to pressure in a new way that Benjamin Netanyahu, who's not exactly popular at home, will have to listen to?
I think that's the core question. President's persona, alone among modern presidents, he considers himself part of the Israeli story, and is preternaturally, his emotional support for Israel literally is impressed on his DNA. The politics, as you point out, he has to be concerned about the rising tide of opposition to the Democratic Party, but the Republicans, who have emerged as a sort of Israel right or wrong party, are also waiting for him to pressure the Israelis so that they can pressure Joe Biden. And finally, there's, I think, the president's realization that he doesn't have many good answers to the two or three critical questions that the Israelis are facing with. How do you prosecute a war to eradicate Hamas without an exponential rise in Palestinian deaths? How do you surge humanitarian assistance into a war zone? And finally, what do you do about the proverbial day after? I expect it's going to be weeks and months after. So I think part of the reason he's reluctant to press the Israelis hard so far is because he doesn't have better answers for them on these core questions.
Aaron David Miller, you're a student of this with your books back 30 years. Don't go out 30 years forward, but I'm going to give you 5 years or 10 years forward. Is our relationship with Israel irrevocably changed?
Fascinating question. The headline would suggest that generational changes in voter constituency, in Congress, the growing divergence between the United States and the values proposition that Israel is a liberal democracy, more or less seeking the same things that we do, and growing policy differences suggest that, yeah, there is a lot of fraught tension in this relationship. Whether it's a headline or a trend line, that's the key issue. I suspect that the operating system that has kept the U.S.-Israeli relationship pretty much very close together is going to continue for quite some time. But again, we support Israel because it's in American interest to do so and because it reflects American values to do so. When those things change in the face of a right-wing Israeli government that's pursuing opposite policies, both at home and with respect to diplomacy on the Israeli-Palestinian issue, then I think the U.S.-Israeli relationship will begin to change.
That tension is continuing to build. Aaron, thank you, sir. Fantastic to hear from you. Aaron David Miller there of the Carnegie Endowment for International Peace.
Torsten Slok. He's chief economist at Apollo Global Management and writes a piercing short note each morning. And here he harkens back to the skeletons in the closet, the worries that those older have about, is this time like, well, try 1972, is this time like a nifty 50 or the point where Polaroid and Xerox were one of the five magnificent five that were out there? Dr. Slok joins us this morning. I loved the equal multiples now with 1972. I believe that ended ugly. Do you take that over to an analog that this will end ugly?
Well, we still, of course, have to wait and see exactly how AI will be used, and no one really knows how it will be implemented and how much productivity we'll get out of it, or how much more consumption or welfare overall. But the bottom line really is what we can track is the valuations. And what I did write in the note today is exactly that the valuations and the trajectory is beginning to look quite similar, including the levels we're at with the PE for AI stocks, or the Magnificent Seven, now at above 50 on a trailing basis. It does make you wonder a little bit whether this is indeed going to have a different story compared to what we've seen before, or whether this is actually going to be similar in some ways.
I mentioned Tom Gelvin years ago at Donaldson, Lufkin, Jenrette, who was very top-line sales specific. Are we going to have the nominal GDP to support the Magnificent Seven, even if they level out, or to bring the breadth up in a good market?
Well, the problem is that the S&P 493 has basically been flat for the last year. So the conclusion is that so far, all the market gains have been driven by this handful of stocks. So that, of course, also should bring us all to the discussion, okay, is this sustainable? To what degree? Is this something that is a good representation of the overall index if you really end up just buying into one simple story, namely AI?
Which is the reason why a lot of people are focused on the consumer, to understand exactly where we are in this spending picture. And I want to go back to what we really began with, this idea of, are we seeing sustained sales and a sustained strong consumer, or are we just seeing these shifts underway, regardless of who ends up benefiting the most, but shifts underway that represent strength in pockets, but not in the overall picture?
Yeah, and I do think that it is clear that the shifts have been towards services. So that's why goods have generally been slowing down. Another strength point, as you're pointing out, is that we have also seen strength in online. But if you really back up and look at the data for how is the consumer doing, well, we just heard your previous guest talk about trading down. If you look at the delinquency rates for auto loans have been going up, the delinquency rates for credit cards have been going up. We're seeing across the board the level of interest rates are beginning to bite harder and harder and harder on consumers. So the conclusion, of course, is that the Fed is actually achieving exactly what the textbook would have predicted. Namely, the slowdown might not have been as fast as we all thought just a few quarters ago, but it is still playing out. The slowdown is here and it will continue. We still have the worst ahead of us. It is the case that monetary policy is biting continuously also going forward.
What's the distance between Goldilocks and a full-blown recession?
Well, the runway that we are on here for slowing the economy down from a Fed perspective certainly is that inflation is coming down. The labor market is also gradually coming down. And we got to get a soft landing, not only in inflation, but also the labor market. But we're beginning to see the unemployment rate has gone up from 3.4 to now 3.9. That's created a lot of discussion about the SAM rule and to what degree that's an indicator of a recession or not. But the conclusion to your question, Lisa, is I do think that we should view this in the broader context of what is it the Fed is trying to do. And the Fed is trying to slow the economy down. That's why they raise interest rates. They raise interest rates because they want us to buy fewer cars, fewer washers, fewer refrigerators, less furniture, fewer iPhones. And because of that, we should over time continue to see that process play out.
There is a real tension right now, and I see this under the notes, underpinning the notes, calling for 5,000 or 5,100 on the S&P by the end of next year, which is how the Fed will respond to the slowdown that they wrought, that they wanted to see. Will they cut rates aggressively just simply because they're tightening the screws at a faster pace as growth slows? Do you buy that they will do that even if it keeps perhaps the economy afloat and prolongs this period of disinflation?
Yeah, this is a really important discussion. In Tom's language, we are looking at the Taylor rule. How much weight do they put on inflation? How much weight do they put on the labor market? So far, all the weight has almost entirely been on inflation. And the question is, next year, once inflation does get closer to 2, will they begin to shift their attention over towards the labor market? In other words, are the coefficients changing so that we put more weight on the labor market now that the labor market is beginning to show some signs of weakening? I appreciate that jobless claims are not slowing, but the work week is coming down. If you look at job openings, it's coming down. A number of indicators are suggesting that labor demand is weakening. So I do think that they will begin to shift away from focusing purely on inflation to begin to focus also more on the labor market.
Well, on the Slok rule, This is like the Taylor rule. I'm inventing it right now, folks. The SLOC rule. Look for this. The SLOC rule is a 3-month moving average of non-farm payrolls. What statistic do we need on a 3-month moving average of non-farm payrolls where we make the great Taylor to SLOC shift?
See, if you look at your latest number for non-farm payrolls, it was 150,000. If
Surveys 188, 200.
And if I type ECO Go on Bloomberg, I will see that by second quarter of next year, non-farm payrolls will, on average, for April, May, and June, be 35,000. So now you start wondering, 35,000, so now you start wondering, that's the average, so that can have some fluctuation. Now you start wondering, how is the S&P going to trade if we get 35,000 in non-farm payrolls? What if it even goes below zero? The risk is here that we may have a runway, and the lagged effects of monetary policy essentially beginning to be a bigger drag on growth.
Adobe just out. Amy, thank you so much for this. This is Bramo spending this weekend. Adobe, a $12 billion to $12.4 billion Cyber Monday spend. Last year was $11.3 billion. But to your distinction, that's cyber. That's just, we're parsing out how all of us are glued to Amazon.
And it's Cyber Monday today, let alone all the other spending that we've seen over this period of time. Really, I mean, honestly, the distortions have been incredibly difficult to really pick up on, which is the reason why I'm listening to what you're saying, Torsten. This idea of the labor market weakening and the Fed may be responding to that. And I'm thinking about, well, people still have money to spend. Their real wages are actually going up. And oh yeah, this is a job-full recession that people are expecting. This is what they say, right? That people are hoarding labor. This is a new world. Do you push back against that?
Well, there is in your weekend reading from the Fed, the working papers that write about this, there is some debate between the Boston Fed, the San Francisco Fed, the New York Fed has also written about this, the Board of Governors has also written about this. The key issue still is, it's very clear that we are ultimately running out of savings, or excess savings in the household sector. The question is, some people view that has already happened, others view that's about now, others view that may only happen in the next few quarters. But the trend is very clear. The Fed is getting what they want. They want a slowdown, and that's why you will ultimately get excess savings running out. And let's not forget, student loan payments started on the 1st of October. That's why retail sales for October was relatively weak. If we put all these things together, I still think that the slowdown continues.
Deutsche Bank put out a forecast for 175 basis points of Fed rate cuts next year. Is that feasible with the recipe that you just put out there?
Well, that does require, of course, quite a hard slowdown in the economy. That certainly requires a recession and a hard landing. The question is, that's not what the consensus is expecting at the moment. But it's clear that if we do get a sharper slowdown, and that is also what the consensus is expecting, it's just above zero. DB is expecting it below zero. Both scenarios make sense on their own, but the conclusion still is we still have more downside risk from where we are at the moment.
I got to go back to your day job a couple of years ago before you got this easy slog with Apollo, and that was with Deutsche Bank. Rishi Sunak, the Prime Minister, told our Francine Lacroix adamantly he is not prescribing austerity. You and Folkert Landau live this at Deutsche Bank of the continent of Europe and of the United Kingdom. Is there a risk they slip into an incorrect austere policy?
Well, the problem is that both the UK and Europe have some same list of problems as the US, broadly speaking, and then they have some additional problems.
We did stimulus. We did a Lockean New World stimulus. They're stuck in the old world. Is it that simple?
Well, in some sense, fiscal policy is certainly very different. In the US, it was much more aggressive than what it was in the UK and Europe. And in that sense, all the rules that, in particular, the Growth and Stability Pact in Europe, but also in the UK, have certainly played a very critical role in why fiscal policy has been very different in the UK relative to the US.
But fiscal policy will be more expansive than perhaps some people would say, given where rates are. That's what we saw from Germany and the recent prognostications over there. Do you think auctions matter?
I do think auctions matter a lot. And as you know, as you just talked about, 2-year, 3-year, 5-year, and 7-year this week is very important. And if you go also and look at the auction sizes over the last several months, they have gone up. And as they continue to go up, the risk really here is that short rates may eventually come down, but we may have a steepener because long rates may potentially not come down as much because now we are dealing with this supply issue that potentially could put upward pressure and limit how much of a decline we can get in long rates.
Let's revisit a banner from 2 hours ago, outnumbered again. Pharaoh gone, SLOC here, auctions matter 2, no one cares 1.
I think we were at 2 before. Now I think we're at 3.
Yeah,
I'm just saying.
It's just so it's like 3-1 is how we're going to take that. And
they matter. It depends if you care. I care.
Well, there was a 30-year auction a few weeks ago that mattered quite a lot.
Yes, exactly.
Well, thank you, Dr. Slog. It's good of you to
please stick around.
Remind me of that. Torsten, go away at least till next week.
No.
by Steve Schwartzman, of course, of Blackstone. Steve, thank you. You were just on stage with the Prime Minister, Rishi Sunak. How much are you putting in the UK? What are you most excited about when it comes to UK growth?
Well, we've been putting a lot of money into the UK. First of all, we're doing our headquarters building here, which is a very significant size building. It'll be the largest built in the Mayfair area in the last several decades. We bought 2 companies in the last 2 weeks in the United States, in the UK, and we have a total of 70 billion pounds. That's close to $90 billion of investments in the UK, with 37,000 people working in these companies in real estate.
But Steve, what stands out as the biggest strength actually for the UK? Because there are many questions. There was an autumn statement. We're not sure how they're going to fund some of the tax cuts if they continue down the road. And we don't know if the Conservatives are in power in 12 months.
Well, the big advantages of the UK are the English language, the rule of law. They have a terrific university system. They have great life science areas. They're the number one tourist area in Europe, which actually I found surprising. And so they have a lot of pockets of strength. They've been through a complex time politically, but if you look longer term, the rule of law in the UK is very strong. Their regulatory posture has been quite consistent over time, but we forget that these are good things, and not all places in the world have them. And so I think I'm not an expert on UK, sort of laws in the sense of what they're doing politically. I think their autumn statement on balance, which was stimulative, is a good and necessary thing for their economy, and they have a much more open approach to immigration at the top levels of education, which is good for helping to power an economy. So I think there's some interesting things going on here.
Steve, what can you tell us about private market valuations at PE firms? So in general, do you see LPs actually demanding more information on marks and more, reporting requirements on valuation? Is that something that's shifting?
I don't see a big set of enormous concerns on that. What always happens at this stage in the cycle, when you go to very high interest rates, and the world sort of starts slowing down, is that deals slow down. So for LPs, their biggest concern is they're not getting capital flows back that they normally were depending on, because people aren't selling assets. These type of cycles always end, and things return to normal. It's quite interesting that we just did 2 deals in the UK in the last 2 weeks, one in the affordable and what they call social housing area, one in computer software. Both are $1 billion, $2 billion type deals. We're doing a number of things in the U.S. now, some of which have been announced, some of which haven't. We just were involved with a situation in Norway that's $12 billion. So the deal business is not totally in mothballs, and these things start again. And I think we're more on that side of the cycle, although it has been, somewhat dreary for a year.
So in terms, for example, of real estate, I think you're raising an opportunistic fund. $10 billion, how's that going?
Well, we're raising money for a European fund. Actually, we're always raising money for a lot of funds, Francine. And, we've gone through a big fundraising cycle. So we have over $200 billion. It's one of the biggest pools of uninvested capital in the world. And that will be deployed in due course. Interestingly, in real estate, which you just asked about, we're seeing a good deal of volume buying things in Europe because European real estate is under pressure in large part because interest rates were so low here for so long. Sometimes in countries they were negative. So the borrowing costs to own real estate were next to nothing. And now it's closer to 6%. So if you have to carry a whole portfolio that used to cost you next to nothing at 6%, they need to sell things. It's necessary to just hold their other properties. And so we're seeing some very, very good buys in that kind of environment because unlike most people, we have enormous capital and can buy the types of real estate that we like, whether they're data centers, whether they're warehouses, whether they're student housing, where those sectors have done very well.
Steve, what can you tell us about REITs? So have you seen any redemptions in that? How's that going?
Rates?
REITs. How do you say? B-R-E-I-T. You say
B-REIT.
B-REIT.
Yeah. Well, those redemptions have gone down. They're, I think, 40% or something like that of what they were a year ago. And so that pool of capital is actually doing quite well compared to almost all other real estate. And so, we look forward to that sort of ultimately going back to a very normal kind of world.
Overall, does UK politics seem benign compared to the US, but also what we saw in the Netherlands?
Well, commenting on politics of other countries, let alone our own, which has a sense of drama and sort of incredulity, is outside of my remit.
Fair. Steve Schwartzman, thank you so much, as always. Steve also has to get to a meeting right here, because people are coming and going in all the corridors, of course, of Hampton Court Palace, John.
Subscribe to the Bloomberg Surveillance Podcast on Apple, Spotify, and anywhere else you get your podcasts. Listen live every weekday starting at 7 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can watch us live on Bloomberg Television and always on the Bloomberg Terminal. Thanks for listening. I'm Tom Keene, and this is Bloomberg.